Hi everyone, and thank you for joining us. We are excited to welcome Ross Healy, who is the Chairman and CEO of Strategic Analysis Corporation, who began his investment industry career more than three decades ago as a securities analyst for Midland Ostler Securities. Mr. Healy was also co-founder of Scepter Investment Counsel, a leading Canadian money manager. He went on to become Director of Research at Merrill Lynch Canada, and during this time provided support to Dr. Vern Attrell, the late theorist who decoded the mathematics underlying the theory of accounting dynamics, upon which the SAC methodology is based. When Merrill Lynch ceased its Canadian business operations, Mr. Healy joined SAC as Chairman and CEO, and he continues to contribute investment analysis to print, radio, and television media. Mr. Healy, thanks for joining us today.
Okay, thank you, Stephen, and thank you for taking 25 years off my life. I've actually been in this business for 55 years. However, sometimes I kind of want to forget about that as well. So anyway, hi everybody. It was quite a debate last night, wasn't it? If debate is the word. What came across to me kind of loud and clear is that both candidates talked about the malaise that is gripping the United States and its symptoms, but no one addressed the heart of the problem, the one thing that is killing the U.S. economy, and I don't mean the COVID-19 pandemic. I'm referring to the brutal condition of the U.S. balance sheet, which makes most necessary changes unaffordable and therefore out of reach, whether it's serious money for Medicare and Medicaid reform, which they brushed over, Black Lives Matter, or dealing with the gross inequalities that have risen in that country over the past 12 years. So with that in mind, I'm going to attempt to fill in some of the blanks. But first, let me ask you a question. At present, there are 195 countries. In the past 120 years, since 1900, 58 of them have seen their currency collapse. Their interest rates shoot to the moon, and their poor citizens sink into abject poverty. If you were an economist, how interested would you be in finding out why this happened, and more importantly, how it could be prevented? Well, I can give you the answer. With one single exception, there appears to be no interest at all. That one economist, Ken Rogoff at Harvard, when he virtually found the answer, was totally ignored because he had no mathematics to back it up, only statistics. And we all know about statistics, don't we? There are lies, damn lies, and statistics. Well, there's very little drama in economics most of the time. It's not called a dismal science for nothing. But there is one place that things can get really exciting, and that occurs at what we call the event horizon of the black hole condition in economics. And that is the precise place where the total weight of debt on the economy reaches the point where the economy buckles and starts to collapse. That event is certainly not a rarity, is it? It's happened 58 times already. Indeed, given the current highly indebted condition, fiscal and monetary condition of a lot of the world, the US in particular, I would think we would like to know how close we are to a similar outcome at the present time. Well, hopefully today we're going to find out. But to go back, to answer this question, I've got to go back some 41 years. Okay, in 1979, Arthur Laffer proposed a very interesting curve called the Laffer Curve, in which he showed the trade-off between tax rates and the amount of money raised. And the bottom line, the essence of the Laffer Curve was that if you cut tax rates and corporate tax rates in particular, then what will happen is that the economy will start to grow at a faster rate. And of course, what will happen if that occurs, then is that the extra tax revenues that will flow from that excess growth will more than make up for the fact that you didn't cut expenditures. Well, the Laffer Curve, and indeed this whole notion that cutting taxes is a good thing, has kind of really seized the imagination of the American public. Unfortunately, 41 years later, the combination of low taxes and no government expenditure cuts has led the country into a pretty serious condition. And we're going to take a look at that in a moment. Well, the same year that Arthur Laffer showed his famous Laffer Curve to Ronald Reagan, by the way, who was the one person that he really had to convince. My late friend and the founder of my company, Dr. Vern Attrell, wrote a book called How All Economies Work. And in it, he essentially laid out a physics of the balance sheet, a mathematics, if you like, of debt. And what I have done is I have summarized that book very nicely into a construct which, by the way, it's a theorem. It's like the Pythagorean theorem. It's mathematically sound, and you'd have a very hard time pulling this one apart. Now, what do we see here? What we see here is that debt has two faces, okay? When an economy is under-leveraged, okay, its debt to GDP ratio is over here. When an economy is under-leveraged, adding debt has a huge and positive impact on the economy. Once you cross over, however, that level, that peak level, and start coming down, then the more and more debt that you pile on does less and less work until you finally reach a condition that we call the black hole condition down here. Anyway, more on that in a moment. Well, as I say, there's good news and bad news. So let's start off on the good news side, and let's look at China some 30 years ago. Okay, China was an extraordinarily under-leveraged economy. It was really virtually an agrarian economy, and they were really kind of living hand to mouth, almost a barter kind of economy. What little money there was highly prized because there was so little of it. Well, 30 years ago, when Mao Zedong died, a whole new generation of people took over in that country, and they adopted modern banking, money and banking principles. And what happened? Well, as they added more and more and more debt to the economy really surged. Now, at the peak of the Attrell curve, as we will now identify it, China was growing at 8, 9, 10% per year, and people were just astonished at how fast it was. Well, this had nothing whatsoever to do with the magic and the mystery of the Chinese government. It had everything to do with the addition of debt. And in that, they were very similar to Japan. When I came into the business 55 years ago, we were all in awe of the astonishing growth of Japan. By the way, for exactly the same reason, the addition of debt to the economy. At one point, Japan was acknowledged to be so rich that the land surrounding the Imperial Palace in Tokyo was worth the totality of all of the real estate in California. Some said actually in Manhattan. Well, a funny thing happened. Japan kept on going. Listen, you raise debt and you create wealth. what do? You keep on raising debt and you create even more wealth. Well, what happened is, of course, that Japan then began to slide down, okay, that lateral curve. And what happened is they got very, very close to this condition, which we called the black hole condition. Now, the black hole condition starts at 0.289, or actually $3.50 of debt per dollar of GDP. And the question is, how on earth did we ever get here? Well, it was simple. Here was the U.S. economy under Reagan. He cut taxes. The stock market certainly bloomed as tax rates fell. Of course, the debt to GDP ratio was increasing all the time, as you can see here. Finally, we got to 1992 when Bill Clinton came into office, and he realized that the U.S. was running a vast and chronic deficit, and he'd better do something about it. So what did he do? He raised taxes, balanced the budget, and paid down debt. And what happened? The U.S. just took off like a scalded cat. Well, when Bush came in 2000, he couldn't out Reagan, at least out Clinton, but what he could do is he could match the effect that Reagan had on the economy, and particularly the stock market. So he slashed taxes and didn't cut government expenditures either. Well, by 2007, 2008, the U.S. had actually slipped below the black hole condition, and when they had a recession, it was the worst recession since the Great Depression. Since that time, the U.S. has not rebuilt its balance sheet. It has been actually moving right along that 289 level. Very similar, by the way, to Japan, which has been doing the same thing for 30 years. Now, all of a sudden, along comes the COVID-19 epidemic. Well, I haven't shown the effects here, but of course what's happened is that the debt on the economy has gone way up and the GDP has collapsed. So the debt to GDP ratio is somewhere down here, basically in the black hole condition. Well, we call that a first order bankruptcy because the effects of bankruptcy hold. And that is to say that what you produce, you cannot sell for enough to get your money back. In other words, you're always losing money, essentially running chronic losses. I saw this actually in Greece and Spain back around 2013-14. And Greece I was particularly interested in because when they cross over that condition, a couple of things happened. And the first is that the GDP collapsed. It collapsed by some 25%. Initially, interest rates really spiked up. But of course, Greece doesn't have its own central bank. And the ECB would not finance their further incursions into the debt market. And Germany, of course, who had actually been in that black hole condition themselves in the early 1920s, was absolutely adamant that they would not finance that, and they've been sort of staggering along ever since. However, the lesson that we need to take out of this, and the lesson that's happened to all countries, is that falling into that black hole condition has some negative effects. The problem is right now that we've fallen in here all right, but that's because of COVID-19. And therefore, we really can't tell the difference between the COVID-19 pandemic, recession, depression, and the black hole condition. I think we're going to find out what that is in time. But when you have basically cast a fog, basically a smokescreen over everything, then what people are going to do about it is now the fascinating question. Well, one of the interesting things that I take out of all my studies of both the United States, but also other countries that have fallen into this condition, is that there's a sort of a pathology of insolvency. And the first one is, of course, as we come down to the black hole condition, real economic growth grinds steadily to a halt. And in the last 10 years, real economic growth in the U.S. has been very, very slow. It's been in total about the addition of people coming into the country, and probably something to do with the fact that they really don't measure inflation terribly well. But economic growth grinds to a halt. If that's the case, then borrowing for capital investment necessarily dries up. And of course, if that happens, then the velocity of money falls. So let's take a look at the growth of M2 in the United States, but we'll also see what has happened to velocity of money. And I have seen this in every country that I have examined. I've seen it in Europe. I've seen it. I see it in Japan. And my guess is, of course, that as we see the United States kind of falling over that edge, my guess is we're going to see it in China as well. Recently, the Fed has really put the pedal to the metal and just ramped up M2 growth. It's just incredible. How has the economy reacted? Velocity has collapsed almost to zero. It's as if the economy is pushing back against the attempt of the Fed to push them into that black hole. Well, if there's no demand for money, what happens to interest rates? Well, of course, they fall to zero. And that effectively loots middle-class savings. However, the financial economy soars. Bond prices go soaring. And of course, along with that, so does the stock market, helping the wealthy to become even more wealthy. Inflation, as commonly measured, falls or appears to fall as demand declines. Has it fallen in the United States? Well, not really. There's an interesting index, the Chapwood Index, which you can find on the net. It measures some 500 items in some 50 U.S. Cities, and if you look at the numbers, their inflation, their cost of these 500 items is popping around at somewhere at the 10 to 12 percent per annum, and has been doing for some period of time. And incidentally, another cost which we don't measure at all is the cost of an additional dollar of GDP, which rises from $1.45 at the top, okay, of the lateral curve to $3.50 right now. But does that count? The economist pays no attention to it whatsoever. Well, we got to continue. Government balance sheets get worse and worse. And when you can't afford to do things, political dissonance becomes extreme. Okay, if I am to get something in a no-growth economy, I have to get it out of your hide, as it were. and you are darned if you're going to give that up. And didn't we see that last night? We had the right against. I would probably describe Biden as being kind of the middle, and neither one was prepared to concede an inch. Political distance in the States is something else again, as compared to how cooperative the parties used to be in years gone by. Now, central banks are left holding the bag, and for central banks, every problem is resolved by printing money. And of course, what happens is that modern monetary theory rears its ugly head. Now, Stephanie Shelton, I think, has written a book, or Kelton has written a book on modern monetary theory, and all that is essentially Arthur Laffer recycled. Okay? He says, cut taxes, but don't cut expenditures and borrow money. Well, modern monetary theory says forget the cutting expenditures and the raising and the lowering taxes. Just raise money, because as long as it's accepted, then of course things are okay. But as we saw by looking at the Laffer curve, once we get into the black hole, then really nasty things start to happen. And in other countries, in 58 other countries, it has led to the collapse of their currencies and a huge spike in interest rates. Well, two final questions. Is there a way out? Well, Bill Clinton showed the way, as I said. Raise taxes, pay down debt, balance the budget, go up the Laffer curve. Okay? That's how he did it, and it was wildly successful. When he left office, the consumer confidence was at a high. The U.S. dollar was as high, I think, as it's ever been. The stock market was on fire, and the economy was just blazing away. So, yes, it works if you go up the Laffer curve. However, at the present time, it requires a great deal of political courage and leadership, because you are now leaning against a very, very powerful 40-year wind, okay, pushing you the other way. But the other and rather more profound question is it possible in this environment? In other words, here we have the COVID epidemic, our pandemic, pressing down on the economy, and we have 322 million Americans saying to the government, well, you gotta help me out. By the way, 322 million, that's the 99%. I've left out the 1%. I don't think they care particularly one way or the other. So it may not be possible. And therefore, the question is, what are we going to do about it? Well, hey, this is the Money Show. Did you think I'd forgotten? Well, not at all. Okay, so what we've got to do is say, all right, what works? Well, the usual suspects in the black hole world are already shining. And first and foremost, of course, they're precious metals of all sorts, and that's now spreading into copper and other metals as well. The other thing that has worked from time immemorial and very well is real estate. I think people are kind of looking around and saying, well, you know, prices in Toronto, I understand, are supposed to be up some 20% this year. And down in the States, real estate is just moving. It's just so fast. It's unbelievable. People are, I think, are attributing that to 1% interest rates. I'm not. I attribute it to the fact that we're in the black hole. Then the areas that should move are moving. The third is hard, productive assets. Okay, cash and bonds, if we got into a real inflation, tend to do in a purchasing power sense very, very poorly. So if we start to get into that, and we should be watching it, you should be ready, I think, to shift your money into places which will give you some protection. However, having looked at the whole Weimar experience from the beginning of it to the end of it, I can tell you that there was an awful lot of volatility, and I did the same study for Mexico back in 1980 through 1982 when their currency collapsed and they went into their own black hole. The volatility was quite something. However, that's what survived in the end. Anyway, thank you very much for watching, and if anybody has any questions, then let me know, and I will answer them, or I will try to answer them.
Awesome. Thank you, Mr. Healy. That was a great presentation. Doreen has a first question here. Where is Canada relative to the black hole?
Okay, we're better than the U.S. There's no question about that, and we have some saving graces. For instance, our Canada pension plan. Social Security is completely unfunded, and therefore, as a mountain of debt sitting hard on the U.S. economy, that makes their situation actually even worse. We have been very wise in that sense. Number two, we've been very wise in our bank regulation to keep them out of to prevent disaster from happening to them, as happened to the States in 2008. It isn't that we're sort of out of I was going to say out of the hole, but we're not in the hole. But we're not in good straits. We're basically following the States down, and of course, if they run into severe problems, we're going to have our own share of them. But we are better off than the States, and I think that's why that the Canadian dollar has been sort of oozing up gently. We're not so dissociated from the States that we can say, hey, we're independent, because we're not. But we are relatively better off. So I hope that answers the question.
Awesome, thank you. Nancy has a question. Can you clarify what hard productive assets you would recommend?
Anybody that produces something necessary, whenever I say that, I sort of keep thinking of Loblaws and Metro, places that you just got to go to. And I would look for those kinds of assets. Those are the ones which, as I say, in Mexico and in Weimar, Germany, they were the ones who came through. People who have something necessary to sell.
Thank you. We have a few people here asking if you could just elaborate a little bit on what a hard productive asset is, and if there's an ETF that's suitable for that.
No, not of which I'm aware. If I were one of the various banks and so on that package up ETFs, I would get in touch with me and say, okay, Ross, give me a bunch of ideas, and we'll put together a hard asset ETF. By the way, one thing I didn't mention, and that is to say that if you would like a copy of my study, Black Hole Economics, including all of the mathematics that make up that curve, okay, they're all laid out there. I have to say that they're free, since they've been in the basically in the market for 41 years, so I can hardly claim that I have something new and novel. It's just that it's taken 41 years, I think, to even get acknowledged. Okay, other questions?
I'm sorry. How would someone get the slides?
Oh, I'm sorry. Just Google black hole economics. Bang, up it'll come.
Awesome. Thank you.
Yeah, very, very, very simple.
What percentage of investable assets should be in precious metals?
Well, that's a really, really interesting question, because it goes to the heart of how much volatility do you think you can stand on the way from here to there. If nothing is done, and unfortunately, I don't see the U.S. doing anything about their fiscal condition, then I guess about all of the precious metals that you can stand, because if your alternative to holding precious metals is basically our bonds and bank accounts, they tend to lose their value, their money, and that, of course, that's happened, as I say, 58 times since 1900. However, we can go back in the depths of history and find another example of a great empire that failed under the weight of debt. And of course, that was Rome. I'm not comparing the US to Rome, but I'm saying that no matter how great the empire, debt will bring everybody down to the same level.
Thank you. How do you foresee the possibility of demand raising for the gold or silver relative to the recent election results of the United States?
If Trump is elected, it will likely, or it could well accelerate the demand. It very much depends on what happens with Powell. The U.S. Fed, or Jerome Powell, came out just a little while ago, and he said, "Look, even if the employment rate rises, but it still is below a certain threshold, and even if we see inflation rising above maybe, say, 3%, we are going to pay attention to the unemployment rate." Well, listen, talk about horror. I read almost exactly the same thing in the minutes of the Bundesbank back in the early 20s. The bank said the same thing. And when inflation got going, they didn't dare, and they admitted it, by the way, they didn't dare sort of pull back on the stimulus and the money printing, because they thought, oh my gosh, should we do that? We will essentially undo any good that we have done so far. And of course, we all know what happened in the end there. So what we really have to do is we're not going to invest just stupidly and blindly and just assume that nobody will do anything. Something can be done, but the question is, who has the political will and the courage to do it? And secondly, as long as this COVID pandemic hangs on, then we basically have got a U.S. Federal Reserve Board, which is out there pumping money. Well, that simply fortifies my my argument for gold and real estate.
Thank you. What do you think about the European debt situation?
Just as bad. Not all countries are as bad. The Germanic countries actually, they're not in fabulous shape. Don't get me wrong. They're way down the actual curve, but they're also way off the actual black hole condition. It's more the countries like France and Italy and Greece, still Spain and so on, which are still in very poor condition. So you've got to be a little bit selective, although. Of course, as the euro rather is a kind of a compendium of all of those economies, and there the debt to GDP ratio of the entire economy is at the black hole condition. Therefore, I'd have to say they're no better off than the United States.
Thank you. We have time for one more question here. Are other commodities such as oil and/or gas investable, useful as a hedge, and what do you see happening here with the various currents?
Yeah, that's a nasty question about oil and gas, because you know you're struggling on one hand against the green economy, and on the other hand against no matter how you slice it, a commodity which is going to be in demand for practically forever. Not necessarily to burn, but for chemicals and all of that sort of thing. Those uses aren't going to go away, and possibly quite forever. So, as people have said, the cure for low prices is low prices. So you put enough producers out of business, and their survivors maybe will get back. However, I wouldn't care to choose the survivors right now, because all of our own work on those companies continues to point to potentially lower prices and indeed bankruptcies. So I think it's a bit too early to look at oil and gas. As for currencies, I don't know where you go for currencies. You can go to the kroner, I guess, of the Scandinavia. But gosh, those are, if you're in the United States, you can't pack everybody into the kroner. That's for sure. And perhaps the Swiss franc could be another area, but that old song by Tom Lehrer, "We'll all go together when we go," probably has a lot of truth today.
Well, thank you, Mr. Healy. That was a fantastic presentation, and we really thank you for being here today.
Okay, well, it's my pleasure, Stephen.